explainer. So today, we're unpacking a massive contradiction that's really sitting at the heart of the market as we see it in 2026. I mean, on one side, you've got this tech-fueled growth cycle that is it's historic. But then on the other, there's this wall of geopolitical fear that has institutional investors absolutely bracing for a major crash. It really is a tale of two completely different markets happening at the exact same time.
Okay, let's just dive right into this because this slide really captures the central conflict perfectly. For 3 years straight, markets have delivered just incredible performance. It's been a fantastic run, no doubt. And yet, look at the other side. Nearly 3/4 of institutional investors, the so-called smart money, are convinced a huge correction is just around the corner. So the big question is, how can both of these things possibly be true at the same time?
To really get a handle on this pessimism, we need to look at what's keeping professional investors up at night. They're climbing what we call a wall of worry. And let me tell you, the bricks in that wall are some of the most complex threats we've seen in years. Let's break them down. Now, what's really fascinating here is the shift in priorities. For the first time in a long, long time, geopolitical risk has actually overtaken tech bubble fears as the #1 concern. Think about that. Nearly half of all institutions now see global conflict and political instability as the single biggest threat to the economy. That is a major change from just a few years ago when market valuations were all anyone talked about.
And listen, this isn't some abstract fear. It's tied to very real policy risks. We're seeing aggressive trade campaigns like this maximum pressure 2.0 thing, targeting Iran with tariffs and sanctions. At the same time, you have serious questions being raised about the independence of central banks. So what's the results? A clear shift in global capital. A staggering 76% of institutions are now planning to either cut back or at least hold their positions in U.S. stocks. And instead, they're looking towards places like Europe and the Asia Pacific. But while all these institutions are hedging against these global worries, a technological tsunami is building. And this is the other side of our Great Divergence, an artificial intelligence supercycle. A powerful long-term wave of growth that seems to be operating in its own little universe, almost completely indifferent to all these macro headwinds. The sheer scale of this AI build-out is just staggering. Let's start with the foundation of it all, semiconductors. According to Bank of America, the entire global market for these chips is projected to hit a historic milestone this year, $1 trillion. That's a trillion with a T, and it's driven almost entirely by the world's insatiable demand for AI. And this slide just brilliantly illustrates how concentrated that growth really is. So of that $1 trillion market, the specialized chips designed specifically for AI, we're talking powerful GPUs, custom processors, they're on track to become a more than $500 billion industry all on their own in just a couple of years. We are literally witnessing the birth of a brand new economic engine. So you might be asking, who's footing the bill for all this? Well, it's the world's largest tech companies, the hyperscalers like Amazon, Google, and Microsoft, the ones who provide all that cloud computing power. They are forecast to spend over $600 billion in capital expenditures in 2026 alone. And get this, a full 75% of that massive sum is being spent directly on building out the data centers and infrastructure that power AI. And look, this isn't just some analyst hype. The industry leaders themselves are confirming the trend. The CEO of TSMC, probably the world's most important chip manufacturer, says it right here. This isn't just about data centers anymore. AI is being adopted everywhere, by you, by me, by businesses, even by entire nations. And all of that is creating a foundational shift in the global demand for raw computing power. Okay, so this brings us to the climax of our story. This is the point where our two powerful opposing narratives, that geopolitical fear and the technological boom, they don't just coexist, they collide in a pretty spectacular way. A historic trade deal was just struck that perfectly synthesizes both of these forces. Right at the start of 2026, the US and Taiwan signed this landmark agreement. You can basically think of it as a $500 billion handshake designed to do one thing: move the heart of the world's most critical supply chain, advanced semiconductors, onto American soil. We're talking $250 billion in direct investment from Taiwanese companies and another $250 billion in credit guarantees to back them up. It is a monumental effort to re-engineer the entire global tech landscape. The motivation behind this whole deal was laid out in incredibly stark terms by the Commerce Secretary. It's a powerful mix of incentive and threat. A carrot and a very, very big stick. Essentially, the message is,
participate in this massive reshoring effort and get preferential treatment or face potentially crippling tariffs. This is geopolitics directly steering the AI boom. So, in a world that's defined by these dueling forces, tech optimism on one side, geopolitical anxiety on the other, where are investors actually putting their money, right? Where are they finding shelter from the storm while still trying to capture some kind of yield? Well, two key areas have really emerged. So, the first answer is a classic flight to safety. As those geopolitical tensions really started to ramp up in early 2026, we saw a massive surge into precious metals. Gold and silver both shot up, hitting historic, headline-grabbing highs. This is what investors do when they're hedging not just against inflation, but against systemic risk to global trade and stability itself. Now, the second answer is a little more nuanced, but it's just as important. Investors are also moving toward tangible assets that generate real income, things like real estate. Now, to understand why this sector is suddenly so attractive, we got to look at a key metric they use called AFFO. As the slide shows, it's basically a measure of a company's actual cash flow, a much truer picture of its profitability than you get from standard accounting metrics. After underperforming for years, a lot of analysts see the real estate sector as a prime candidate for a major rebound. I mean, look at this. Valuations are at their most attractive levels since the 2008 financial crisis. Their cash flow growth is expected to basically double, and they offer solid dividend yields of around 4%. In a volatile market, owning a piece of a tangible, income-producing building starts to look like a really appealing strategic hedge. So the crucial point here, the big takeaway, is that investors are left trying to navigate this massive divergence with no easy answers. On one hand, you have a once-in-a-generational technological revolution, and on the other, a geopolitical landscape that is just filled with risk and uncertainty. And this really boils the entire 2026 landscape down to one central high-stakes question, doesn't it? Which of these forces is going to have the greater pull on the market? Is it the unstoppable momentum of the AI boom, or the heavy gravitational drag of a potential macroeconomic bust? Ultimately, the story of this market is one of isolated, unbelievably powerful growth taking place inside a landscape of widespread uncertainty. So the real question for 2026 isn't whether growth exists. We know it does in spectacular fashion. The question is, in a world that's being pulled in two totally different directions, where can that growth actually survive and thrive? It's a fascinating puzzle, and one we'll be watching all year long.
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.